Hey guys, my name is Ryan, and I'll be starting a educational series on trading topics, mostly covering product knowledge that may be useful in trying to break into the industry or just working in the industry in general. And today we'll get started with an educational covering vanilla derivatives. This is a 101, so very simple, basic concepts. And in terms of it being vanilla, these are very like basic linear and nonlinear products. And we'll mainly be covering options today. But yeah, before we get started, maybe let's talk about what a derivative is. A derivative is a financial instrument that, as its name implies, derives its value from an underlying asset class. And since we're covering options today, there are two main types of options. There are calls and there are puts. And these can further be split into American options, European options, Asians, Bermudans. Um, but we'll mainly be covering American and European calls and puts. European being where you're only able to exercise at the very end, and American being where you can exercise any time before its expiry date. But I guess before we continue, why do we use options? Well, historically, I believe options were just used as a hedging tool. So if you were a farmer or producer of oil and you were unsure of where the price of the asset that you specialize in was going in the future, you could lock in that price today, and that just relieves you of any stress of having to worry about it later on in the future. But nowadays, it's additionally used as a speculation tool. So many market participants engage with the derivative market to make directional bets, whether an asset will move up or down. Um, so yeah, those are the two main use cases of options. I'm not going to write that down. But yeah, let's move on to some terminology. Yeah, so starting with terminology, we have a strike price. Now, the strike price is essentially the price at which you agree to purchase the underlying security if you decide to exercise this option. Second, we have the premium, otherwise known as the price of the option, and that's just the price that you pay to enter this contract. Third, you have the expiry. So these contracts all have expiry dates, and this is just the date at which the contract expires. And then last, you have a multiplier. And essentially, every contract has exposure to an underlying number of shares. It's usually 100, but that can change in cases, and that's what the multiplier refers to. So in terms of actually pricing an option, how do you go about putting a price on something like this, right? It's not something tangible. You don't have a stock, you don't have a commodity, you don't have anything tangible. So how do you price it? Um, Lucky for us, we have a few very smart gentlemen who in 1973 created what's now known as the Black-Scholes-Merton model for pricing a European option. And essentially, this pricing model has four key assumptions. One, that price changes are continuous, so there are no jumps in price. There are no transaction costs or identical taxation. There is constant volatility through time, and last, it's continuously compounded daily, and so these returns follow a normal distribution. And so what this implies is that the stock price, the underlying stock price, follows a log normal distribution. How do we actually price this? Well, you could think of it very simply. A option is made up of intrinsic value, which is the value of the option itself without taking into consideration time. And then there's the extrinsic value, otherwise known as its time value. So for example, let's take a call option at a strike of five, um, sorry, a strike of, let's say, 100. And the stock is currently at a reference point of $103, and the strike, sorry, not the strike, the premium is $5. So how do we split this into its intrinsic value and extrinsic value? Well, this call gives you the right to purchase this underlying security at $100, and it's currently $103. So basic arithmetic, 103 minus 100 equals $3 of intrinsic value. Now, since this option costs $5, that leaves us with um, $2 of extrinsic value, $2 of time value. All right, you could also price like these are like binary options. And you don't even have to think of this as a like financial derivative. You could use this to price anytime you have like different options of things. So let's say in this case you have a 40% chance of the underlying going to $2 and 60% chance of underlying going to $5. How you would price this is it's just expected value, right? You take 0 0.4, the probability of getting one value, and that's 0 0.8, and then you get 0 0.6 times 5. That's 3. Just add those two probabilities together, 3 plus 0 0.8, and that gets you 3.8. So this option would theoretically cost $3.80. You can also price, like, let's say a dice roll, for example, right? A dice has 1, 2, 3, 4, 5, 6, and then let's say the strike is 3, right? So here, strike is 3. So let's say you, and this essentially means if you have a call option with a strike of 3, you can buy the underlying at $3, right? So if you roll a 1, what's the value of this option? It's obviously 0, because why would you want to buy something for $3 when you could buy it on the market for $1? Same thing for 2, worth 0. Same thing for 3, because even though it gives you the option to buy it for 3, you could buy it on the market for 3 just as easily. 4 is where things change, right? If the market value is 4, but you have the contract to buy it for 3, that leaves you with a $1 profit. Same with 5, you have a $2 profit, and then 6 with a $3 profit, right? And then when you add those up together, that gets you $6. So what does that mean? That means this option to uh, price an option on a dice roll is equal to $6. Moving on to payoffs, we can think of payoff in terms of a diagram, right? So we have a diagram like this, where this is sort of the strike, and then this is sort of like the payoff. And then let's say this is the reference at 0. So starting off, let's do a long call position, right? When you buy a call, you have to start off by paying a premium, which is the price of the option. So starting off, you're already in the negative. Um, say this is the strike, and then this axis is sort of like the underlying price. So basically, up until the point which you hit the strike, you are in the negative because you paid money for this. But once you hit that strike is once you start becoming profitable, and then you start to make money linearly. And this is what a long call option looks like. You also have a long put option, which same thing. You essentially, once you hit this sort of strike K, you are losing money. But any price below that, you're making money. Except for this area, which is sort of what's known as a break even at this point. This point's a break even. And yeah, that's what a long put looks like. You are making money up until you hit that strike price, and then you're losing money because you're paying a premium. But then let's say in this case you go short a call option, right? It looks the exact opposite. You are you receive a premium up until the strike, okay? And once it hits a strike, then you owe someone else money. And notice how this can theoretically be infinite because a stock price can theoretically go upwards infinitely. So once you hit that, it just goes down linearly. And then the opposite is true of a short put option. For a short put, it just looks mirrored, right? You have a strike here, you're making money after the strike, and then you're losing money before it. And these are sort of what the payoffs look like for these very basic vanilla options. You can also combine options to create different strategies and create different payoffs. So for example, this is called a straddle, where you essentially buy a call and buy a put at the same strike price. And what this essentially does is, and you'll notice that when you add different legs of options, it's just a vector addition, right? So if you buy a call and you buy a put, it just looks like this. This is the strike. And notice this is where you lose money, and this is where you make money. And essentially what this is saying is you're making money if the stock goes down a lot, and you make money if the stock goes up a lot. And this is essentially a long volatility bet. You also have, for example, vertical spreads. So you can buy, let's say you do a call spread, right? That means you buy an option at a lower strike price, and then you sell an option at a higher strike price. And essentially what this would look like is up until the first strike, let's say the first strike is here, and the second strike is here. It looks like a normal call up until the first strike. You're paying a premium, and then boom, hits first strike. And since you're long that first call, you're making money. You're making money. But since you're short the top strike, which is the higher strike, you begin losing money. But instead of going downwards, remember vector addition, you're actually broken even. And so this is sort of what the payoff looks like for a call spread. And you could do that for a put spread. You could do a 1/2 call spread or put spread, and just play with the ratios to create different payoffs. Yeah. Okay, now let's look at the Greeks. So the Greeks are essentially just used to understand how options change when different inputs change. So let's look at, let's start with delta. Delta is, I guess, the first derivative change of the option price with respect to the underlying asset's price. Then we have gamma, which is essentially the first derivative change of the delta with respect to the underlying price, which I guess you could also think of as the second derivative change of the option price with respect to the underlying asset price. Next we have theta, which is, I guess, time decay. So remember how I said that every contract has an expiry date? Theta measures the rate at which that, I guess, value, that extrinsic value decays. And then finally we have vega, which is, I guess, the derivative of the first order derivative of how the volatility changes with respect to how the underlying asset price changes. And I guess in addition, we can also have rho, which is a measure of interest rates, which isn't that important because interest rates don't change that often. At least they didn't before 2022. But still, they don't change like every day, every minute. They change like whenever there's interest rate decision. Yeah, so these are the Greeks. All right, so now we could talk a little bit about delta hedging. I guess before we get started with that, I guess I forgot to mention an option can either be in the money, at the money, or out of the money. And essentially what this means is if a stock price has value, it's in the money, it's in the money or at the money. But then if there's no value of that option, it's out of the money. And so what that looks like is, in terms of delta, is let's say we have 1 day left until expiry, and the strike price is 100. The underlying asset is at 100, and because we have 1 day left, what do we think this will end? Will it end in the money or out of the money? Well, since the strike is equal to the underlying price, we have an at the money option. And we could think of, let's say this is a random universe. It could either go up or down by the end of the day. That means there's a 50% chance that we end in the money, no, 50% chance that we end out of the money. And so what this means is all at the money options have a 50 delta or a 0.5 delta. So a 50% chance of ending in the money. So now that we have a understanding of what delta is, how do we hedge out that delta? Well, when you think of a stock moves one to one with the underlying because the stock is the stock itself. And so all stocks or like the, I guess, underlying asset has a one delta. And so how we hedge this out is essentially, let's say we have a call option, right? A call option with a 0.3 delta. And so what happens is because um, since this call option has exposure to 100 shares of underlying, uh, as I believe I mentioned before, we multiply the 0.3 by 100, and that gives us a total delta of 30, positive 30. So how we hedge this out is because a stock has one delta, we decide to go short on 30 shares. And then the 30 minus the 30 gets us to a 0 delta, and we are delta hedged. The same thing for puts, but puts have an opposite direction delta. So a put option with, let's say, if we go long on a put option, it could be a negative 0.3 delta. And so what we do is same thing, multiply it by 100, and that gets us a negative 30 delta. And then to hedge that out, we buy back 30 shares of underlying, and that gets us to delta neutral. Yeah. All right, so how is this actually applied in the industry? Well, a lot of, I guess, most banks and hedge funds and prop trading firms have risk parameters, right? You need to hedge out your deltas. And I guess let's do an example here. Let's say we have a world where options don't exist, but the underlying Black-Scholes model does exist. So theoretically, you can recreate the payoff of an option using just the underlying stock. And how that works is, say you have this payoff, right? Let's say you're long a call. You could theoretically recreate this payoff. And the way you recreate that payoff is you sort of use Taylor series or Taylor approximation, and sort of like find out what that slope is at that certain point in time, right? And that slope is equal to the delta of of that asset, right? And so you take that delta and you buy a proportionate number of shares, and if you just keep on buying that same proportionate number of shares at each point in time, or not point in time, but like at each price of the underlying, then you could create that sort of same payoff. So the question is, if we can recreate that payoff using just the underlying stock, what's the point of options? Well, when we think about what the difference is between an option and the underlying stock, one, an option has a time value, right? It has an expiry date, and so therefore the time value decays. Um, and what that leads us to is the concept of implied volatility and realized volatility. So realized volatility is our current volatility that's already been realized, hence the name. And then implied volatility is our future volatility, or what we expect the volatility to be in the future. And so when you think about delta hedging, what essentially happens is you're trading sort of this, uh, you're trading this underlying stock, right? You're trading the delta of the underlying stock for the delta of your option. And so what happens is you're essentially trading realized volatility for implied volatility. And I guess when you think about it, the reason you would hear a lot of derivatives traders be called volatility traders is because you're actually just trading the volatilities. And so that's sort of what this looks like in the industry. And yeah. All right, so that pretty much sums up the entire lesson. Very quick, um, very simple stuff, I hope. But yeah, we'll get started soon on a new lesson. I'll see you guys next time.